Well, I'm extremely grateful to Jim for the very kind things he said and the data he made up on various aspects of my career. I had to expect, I'll add one, Jim. I thought that when I came to this lecture, I would recognize no more than 5% of the people. Well, I guess the profession has been aging a bit with me, because I see a lot of people that I know and interacted with and enjoyed interacting with in various ways in the past, and thank you all for coming to this event. It is customary to say it's an honor to deliver one of these lectures, but this really is, I mean, not one of these lectures, a named lecture. But this really is an honor. Marty has had a remarkable career. He's the founder of the modern NBER as the primary center of applied policy, relatively applied economic research. The modern NBER is not only impressive, it's remarkably user-friendly, it's remarkably successful, and also seems to be very efficient. And I wrote that down before I heard about Rob Shannon being the only person who apparently runs this. Sorry, Jim. One of Marty's, I've been thinking about Marty's successes, and one of his successes is knowing how to choose people. And that is well, Kate, this wasn't directed at you, but it's certainly relevant. So this institution, this institution of the summer camp is really an extraordinary one. At the same time, Marty continued with his own research program on a huge range of issues which developed over the years and hasn't ended, but it included more recently national security and defense. Add to that the superb set of students he's advised and produced, and an almost unparalleled ability to work jointly with his students. And he has left a remarkable impact on the profession. He, I think, has left an imprint on the profession to an extent that almost no one can match in terms of the contribution, his own contribution, and that he has encouraged through others. I'd like to add a personal note on behalf of Rhoda and myself and our children to thank Kate and Marty, who have been the most constant, the most thoughtful, most generous, and most pleasant of friends for over 40 years. We are indeed grateful to them for their friendship and for the many very good things they have helped us do. So for both professional and personal reasons, I'm honored to have been chosen to deliver the Martin Feldstein lecture. Now, I didn't know when I was chosen to do this, when I was asked to do this lecture, that I was going to be the vice chair of the Fed when the time came. I didn't think anybody would have remotely considered that possibility, but now I just heard Jim say he was not in the least surprised, which sort of bothers me a bit, Jim. This was all planned. I didn't know about what job I'd have when I was nominated and said yes, but I did choose the topic after I knew I was going to join the Fed. Now, these are sort of things which, as professors, we regarded as, I used to regard as a sort of technical detail of no particular importance, how you do supervision and regulation of banks. And you kind of tend to think that sort of thing until it rises up and hits you in the face. That would have been a good idea to know something about a topic like that. I can remember countless examples, which I'm too embarrassed to tell you about, of similar things where you say, not interesting, not important, forget about it. And somebody would come and want to write a thesis, and I'd say, oh, that's nothing. And then a year or two later, you'd realize you gave them bad advice, and it was a very good thing. And the same with financial sector reforms. So what I'm going to do is talk about aspects of the implementation of the financial sector reform program that was widely agreed at the early stages of the global financial crisis. It is actually quite remarkable that a group of, an international group of regulators and supervisors in the Basel Committee on Banking Supervision and later in the Financial Stability Board, both of them now G20 bodies which include the G20 countries, plus a few more. There is a law which I'm almost willing to give you $5 to bet on, that there is no G which has the number of members that is represented by the number that follows the G. The G20 consists of about 26 countries, and I can go on with a variety of examples. And the reason there are almost always more, and the reason there are almost always more is that when you leave somebody out, there's somebody really insistent who manages to push his country's way in. Well, we're talking about measures which followed on, or which were introduced or thought about during the worst economic crisis and the worst financial crisis since the 1930s. And I'm giving a little bit of background because it's very easy to forget it now. I'm always impressed when people say you should have done this, you should have done that, and forget to say at the beginning, but what you did was pretty damn good considering the situation. Following the collapse of Lehman Brothers, many of us thought that we were about to witness a second Great Depression. That did not happen, in large part because policymakers had learned some of the lessons of the Great Depression. Nonetheless, the advanced economies were put through severe economic and political tests. Fortunately, policymakers succeeded in dealing with the situation better than many had feared they would. Unfortunately, we're still dealing with the consequences of the collapse and the steps necessary to deal with it. Now, I've heard Barney Frank say that economists have a wonderful technique, that of the counterfactual, to analyze what has been achieved by preventing disasters, but that real people base their judgments more on the current state of the world than on disasters that might have been. Well, true as that is, we should from time to time allow ourselves to recognize that bad as the Great Recession has been, it would have been much worse had policymakers not undertaken the policies they did, many of them unorthodox and previously untried, to deal with the imminent crisis that confronted the United States and the rest of the world after the fall of Lehman Brothers. And for that, we owe them our gratitude and our thanks. Now to the topic, the financial sector reforms. These were prepared within a few months of Lehman Brothers crisis, which is itself, Lehman Brothers failure, which is quite impressive. If I learn how to operate this thing, we'll see what the main elements of the program were. Page down, okay. Not that one, yeah. There were 9 main strands, and I'm putting them up there because I'm going to read them, and it probably helps to, there's a lot of them, and it may help for you to see them as well. This is not a lecture. This is not a slide lecture. This is a lecture illustrated by a couple of slides. The first, strengthen the stability and robustness of financial firms with emphasis on governance, on risk management, on capital, and on liquidity. And I'm going to talk about capital and liquidity as the first topic, first of the 3 topics of the 9 here that I'm taking up. I'll not go through all of them, but strengthen the quality of prudential and effectiveness of prudential regulation and supervision. Build the capacity for undertaking effective macro-prudential regulation and supervision, and I'm going to say something about that. Develop suitable resolution regimes for financial institutions, and then strengthen international coordination of regulation and supervision, especially for regulation and resolution of G-SIFIs. Now, it doesn't matter what applied field you're in. There are acronyms. And you go to a meeting, and if you haven't been to the first meeting, you're kind of lost. But once you've been once, you get it. A G-SIFI is globally, the G is added because they're not all Gs. There are SIFIs, most of them, systemically important financial institutions. And there's been a lot of the focus of the reforms, the regulatory reforms, have been to deal with the big banks, which are the SIFIs and the G-SIFIs. And number 8, find appropriate ways of dealing with the shadow banking system. I will add a word on that at the end. So that's what we're going to focus on, and I'm going to focus on 3 topics: capital and liquidity, macroprudential supervision, and a special topic which embraces several of these called too big to fail. So those are going to be my 3 topics. Well, let's start with capital and liquidity. At one level, the story on capital and liquidity ratios is very simple. From the viewpoint of the stability of the financial system, more of each is better. That's it, from the stability viewpoint. And this is the principle that lies behind the vigorous campaign waged by Anat Admati and Martin Hellwig to increase capital ratios set out in their book, The Banker's New Clothes, What's Wrong with Banking and What to Do About It. And on the cover of the book, the bankers seem to have relatively few clothes on in their description of it. Well, at what level should capital and liquidity ratios be set? We don't have a terrific theory on that, and in practice, the base from which countries work is agreement among the regulators and supervisors who belong to the Basel Committee on Banking Supervision. And that's where many of these agreements come from, and they've typically been spread to the world through another body, the Financial Stability Board, the FSB. Following the global crisis, the Basel Committee moved to the Basel III agreement, which strengthens capital requirements, as opposed to Basel II, which tried to build regulation primarily on measures of risk capital set by internal models developed by each individual bank. That's quite ambitious or quite trusting. And it didn't work for 2 reasons. One, the required regulatory minimum capital ratios were too low, but also because any set of risk weights involves judgments. You've got to make judgments about correlations about which you know very little, for example. And human nature rarely results in people choosing risk weights that make them require to hold more capital. So there's a problem there. In the United States now, the new regulations require large bank holding companies to use risk-weighted assets that are the greater of those produced by the firm's internal models or produced by a set of standard weights supplied by the regulators. So there's a minimum from the standard weights that the regulators have agreed on, and that's somewhat of an achievement. Well, what has been achieved globally? Now, I'll start with globally. A lot has been achieved, and I should say that. The minimum Tier 1 capital ratio, Tier 1 is pure capital more or less, has been raised from 4% to 6% of risk-weighted assets. There's a capital conservation buffer, an extra buffer, of 2.5% of risk-weighted assets, and banks are required to build this up as they earn income, profits. So the required assets are 8.5%. They were 4%. The required capital ratio is 8.5%. It was 4%. There will, in addition, be a countercyclical capital buffer that regulators can raise and lower when needed. It used to be a big puzzle. Larry Summers always used to say about IMF programs, I don't understand why they set minimum reserves that countries have to hold, and they give the countries just enough money to hold those reserves. What are they going to do when they actually need reserves? Well, the capital buffers are the answer to that question in the case of the banks. And they've also set a minimum leverage ratio of 3%. That's the ratio of Tier 1 capital, the capital, relative to total on-balance sheet assets. The typical ratio of on-balance sheet of total assets to risk-weighted assets about 60, risk-weighted to total is about 60%. The risk weights are less than 1, many of them. And then in the United States, the Federal Reserve is planning to propose risk-based capital surcharges for U.S. global SIBs. That's significant, what did I say? Systemically important banks, and those are going to be raised. The regulators have also raised the leverage ratio, the minimum leverage ratio for global SIBs to 5% as opposed to the 3% set in Basel. And if they don't meet the 5%, they will not be able to distribute dividends and pay discretionary employee benefits. So this is a serious constraint. And foreign bank holding companies, foreign bank organizations with U.S. non-branch assets of $50 billion or more will have to form U.S. holding companies that meet essentially the same capital requirements as U.S. bank holding companies with $50 billion or more of assets. Many of these rules don't apply to community banks because they have a different business model. I want to add one point on bank capital. The Swiss and Swedish regulators have gone far in raising capital requirements, including by raising bail-inable secondary holdings of capital in the form of COCOs, contingent convertible capital obligations. The U.S. may be heading in the same, in a similar direction, not by using COCOs. COCOs define conditions under which they convert from being bonds to being equity. And what the U.S. regulators have decided, or nearly decided, is that they're going to require minimum amounts of, quote, gone concern loss observancy. The editor of this speech told me she wanted to change that to going concern loss absorbency, but it's really gone concern. When it goes, these bonds are sold and used to finance internal recapitalization through a new liquidation mechanism created by the Dodd-Frank Act. And there are also liquidity rules, which I won't go into. So what are the critical results so far? Tier 1 common equity ratio. This is the one that should be a minimum of 8.5% by international agreement, which U.S. Regulators have raised a bit, was around 7% before the crisis, is now around 11% on average for the largest 25 bank holding companies in the United States. There are also, as I mentioned, the liquidity constraint. The ratio of liquid assets to total assets has risen from a peak in the first decade of this century of about 12% to over 20%. These are very significant. There was a big, every regulator who told banks to raise capital and liquidity was said, okay, we won't make any loans, and then so forth. And the answer they got, both from the Fed and from Mark Carney, who was then the Canadian supervisor, was you are going to raise your capital ratio through the numerator, not through the denominator. And that is much harder because that means you can't do it by running off assets. So the bottom line to date is that there is a very significant increase in capital and in liquidity held by the large banks in the largest banks in the United States, which account for about 80% of the banking system. At the same time, the introduction of macroeconomic supervisory stress tests in the U.S. has added an important element to the assessment of capital adequacy, as firms are required to hold a capital buffer sufficient to withstand a several-year period of severe economic and financial stress. And the stress tests are a very important addition to the toolkit of supervisors, one that is likely to add significantly to the quality of financial sector supervision. I ran around myself saying for quite some time, well, this was a supervisory failure, and we're not doing much about supervision. Actually, the stress tests are a very significant innovation in the supervisory field. So that's capital and liquidity. John Reed asked me, am I going to answer the question? The answer on this one is yes. That's been improved significantly. It's been dealt with significantly. Is it enough? Well, time will tell. If we had better models to determine what's enough. The problem with meeting the 1 in 100-year test is that they show a tendency to come up every 10 years or so. And but you've got to find something like that. So now I'm on to macroprudential and supervision. Well, macroprudential policy has two meanings. There's the original one, which people glommed onto when Lehman failed and the world blew up, and that relates to the need to understand that the financial system is a system, and that if you pull something out of the middle of it, it has more consequences than the failure of that firm. So it was a desire to supervise the financial system as a whole, emphasizing interactions among financial markets and institutions. That's the use as described by those impressed by Lehman. The second relates to the use of regulatory or other non-interest rate tools of policy to deal with problems arising from the behavior of asset prices. For instance, when you ask a central bank governor, how are you going to deal with rising housing prices at a time when, for whatever reason, the central bank doesn't want to raise the interest rate, they will say, we'll use macroprudential policies. And by that, they mean policies that will make it more difficult to finance houses, make it more difficult in some way or the other to finance housing. Now, these sector-specific regulatory and supervisory policies were used extensively and systematically in the United States between the end of World War II and before the start of World War II until about the 1990s, and are now being used, continue to be used in other advanced and developing countries. I think central bankers are very proud when they got rid of those. Finally, we've got a clear tool which we can use, the interest rate, bang, it works, forget all that other stuff, the markets will do it, and we're not going to intervene in this market or that market. We're going back to the future. The issue of how monetary policy should relate to asset price inflation has been on the agenda of central bankers for a very long time. There are people here who remember papers in the 1960s. I remember one by Armin Alchian and Benjamin Klein, which argued that we should deal with asset prices by putting the prices of assets in this consumer price index. And that way you'd be stabilizing a measure of present and future prices. That didn't go anywhere with the policy community. The issue became more prominent in the United States in the 1990s and in the first few years of this century, and it temporarily culminated in the Fed's mopping up approach, namely that monetary policy, meaning the interest rate, should not react to rising asset prices or suspected bubbles, except to the extent that they affect either employment and or price stability. Rather, monetary policy should wait to mop up the mess after the bubble bursts, including, for instance, by reducing the interest rate. That's what the mopping up is about. Well, you would perhaps say that doesn't sound right, but this policy was tested in the bursting of the tech bubble in 2001, and it appeared to be successful as the economy recovered from 2002 onward, without the use of what is now thought of as macroprudential policy, the use of regulatory and supervisory measures to deal with undesired asset movements. So now the word macroprudential is used primarily in the second sense of the use of regulatory and supervisory non-interest rate tools to affect asset prices. So now I want to go from etymology to economics. And I want to review my experience with macroprudential policies in the second sense, non-interest regulatory and supervisory policies. I'm reviewing my experience as governor of the Bank of Israel to draw a few key lessons about the use of these policies. And to set the background, there was no financial crisis in Israel during the Great Recession. But as domestic interest rates declined along with global rates, housing prices began to rise. Well, this is a normal part of the adjustment mechanism. I'm looking at Greg. I think you have a couple of papers using that approach, and is expected to encourage an increase in the rate of home building. Well, that's what happened in Israel. They started building more houses, but not sufficiently more to meet the demand for housing, and prices continued to rise. Starting in 2010, the supervisor of banks who reported to the governor, which was me, of the central bank, began to implement a series of measures to reduce the supply of housing finance, let's say the effective supply of housing finance. And here is a list of the major measures, and this I want to go through because this includes almost everything that's been used in the world to deal with housing prices. So first, they increased the provisions that banks had to make against loans with high LTV ratios. Then they increased capital requirements against floating rate loans with high LTV ratios. May 2011, and I'll come back to this, they limited the share of any housing finance package indexed to the short-term interest rate to 1/3 of the total loan, and I'll explain what that's about. The Bank of Israel interest rate was reduced to 50 basis points. The banks who everybody says never compete, were competing in selling mortgages, and they really competed, and they got the spread down to 60 basis points. So you could get a floating rate mortgage, a 30-year mortgage if you wanted one, at 1.1% indexed the Bank of Israel rate. And not surprisingly, that was attractive to a lot of people. Well, the measure was that you couldn't use more than one-third, not more than one-third of a mortgage could consist of loans like that. And the other two-thirds had to be indexed or nominal, or had to be adjustable to a 5-year rate with a 5-year weight, either the real rate or the nominal rate. That was a huge change. I mean, we didn't quite think so then, but as I was thinking through it, the yield curve was steep, and the nominal real rate was about 4%. So in effect, you took two-thirds of what had been 1% and raised it to somewhere like 3.5% to 4%. That's a very severe rise in the interest rate, and it worked quite effectively. But prices have kept on rising, and they're still rising. In 2012, but that one had an effect you could see, and it set prices back for a while. 2012, they limited the LTV ratio in housing loans to 75% for first-time buyers, with tighter limits for other buyers. This is, the limit to 75% is a political move, because the first-time buyers are what in Israel are called young couples. And you mess with young couples' access to finance, and it's a problem. This actually reduced their LTV, but it made a lot of noise. And then in 2013, they limited the maximum. This is after I left. August, yeah, it was 2 months after I left. They limited the maximum payments to income ratio of borrowers to 50% with a 100% risk weight on loans with a payment to income of more than 40%. The evaluation of the Bank of Israel is the measure that sharply raised the cost of housing. The interest rate, the effective interest rate, was very effective. That the payments to income and LTV limits were moderately effective, and that there was not the big difference which the literature finds. The literature says payments to income is more effective than LTV. That was not the case in Israel. But that the measures which tried to affect the cost of capital, the cost of finance to the banks, had very little effect. So making them provision more, making them raise their risk weights, didn't do a whole lot. And I think that must have had something to do with the fact that they were able to get deposits at extremely low rates. So it didn't make a heck of a lot of difference what they were doing. Anyway, that's the set of measures that we had, that we used in Israel. And I want to mention 3 key lessons from this experience. They don't follow from what I've told you now, all of them, but they're important. First, the Bank of Israel did not have good empirical estimates of the effectiveness of these measures. What we typically did was to calculate the impact of a particular measure on the effective cost of finance to the borrower. That always overestimated the impact, and the measures were not very good. But we knew that we didn't have good estimates. And what do you do when you've got uncertainty like that? Particularly when you don't want to kill a market, you kind of are cautious. And I believe that because of the uncertainty and the lack of experience with these measures, we did too little on many occasions. Second thing everybody has to remember, measures aimed at reducing the demand for housing are likely to be politically sensitive. this is not like the interest rate. The world thinks the interest rate is neutral. It isn't. You raise the interest rate, you don't affect every sector equally. But somehow the world's got over the fact that that typically hits interest rate sensitive spending and thinks that's pure monetary policy and that's okay. Given that measures aimed at reducing the demand for housing are likely to be politically sensitive, their use requires very cautious and well-aimed measures by the regulatory authorities and may require the use of government subsidies to compensate some of those who are affected by the imposition of these measures. And one often sees, and I've seen it in other countries as well, that there's a conflict between serious risk management by the banks and what the political system wants to happen through housing finance. And that's an underlying source of problems in the use of macroprudential policy. Third, there's generally a need for coordination among several regulators and authorities in dealing with macroprudential problems. And regulation among independent authorities is hard. If you don't have somebody who can say, however it's done, you do this or you do that, everybody's going to insist on their independence, and they are independent. Well, there are two models of regulatory, there are many models of regulatory coordination, but let me focus on only two, the British and the American. As is well known, perhaps not to everyone in this audience, the UK has reformed financial sector regulation and supervision by setting up a Financial Policy Committee, the FPC, located in the Bank of England. It is the supervisor of the whole financial system. That committee can issue any orders to to financial intermediaries. The major reforms in the United States came through the Dodd-Frank Act, and that set up a coordinating committee among the major regulators, which is the FSOC, the Financial Stability Oversight Council. There's a nice paper by Don Cohn, who used to be deputy vice chairman of the Fed before Janet Yellen got the job, who has been appointed to the British Financial Policy Committee located in the Bank of England. The British are really very good about not worrying about nationality and choosing the best governor. If he happens to be from Canada, that's fine. And they've got foreigners on their Financial Policy Committee. Don has written a very interesting article and in which he says that there is a difference between an organization which has the legal power to impose policy changes on regulators and one which is supposed to coordinate among independent regulators without any power to get them to do things. He says, well, there's no unique regulatory model. The UK structure of macroprudential supervision is not ideal for all countries at all times, et cetera, et cetera. But he clearly thinks there are advantages to the Financial Policy Committee. He looks at the structure of the FSOC, our regulatory body, and suggests 6 changes, of which two are the most important. The first is that every regulatory institution in the United States should have the goal of financial stability added to its mandate. Many of them don't. And so you can't tell them what you're doing is going to bring financial instability. That somebody else has to deal with that. And then he also says, and this I think is very delicately said, this is his 6th suggestion: give the more independent, to give more independence to the FSOC. It should also be given tools that can be used expeditiously to address systemic risks. He doesn't explain how that's to be done, but clearly that's a measure. So Don is very careful about what he says, but he's pointing to things which are important and which we need to think about. And I think it may well be that adding a financial stability mandate to the overall mandates of all financial regulatory bodies would help financial stability in the United States when the need comes to have that stability. On number 2 issue, macroprudential supervision, it's not a simple V or tick. There's more work to be done, and some of it may be quite difficult. Finally, I want to talk about too big to fail. The diagnoses of what went wrong with the financial system at the start of the Great Recession generally placed very heavy emphasis on the problem of too big to fail. And I'm going to quote my colleague Dan Tarullo, Governor Dan Tarullo, who explains what happens when governments are confronted by the potential failure of a large bank. Dan says, no matter what its general economic policy principles, a government faced with the possibility of a cascading financial crisis that could bring down its national economy, in its view, tends to err on the side of intervention. Doesn't matter what your principles were beforehand. When you see the train about to bear down on you, you sort of start getting active and deciding to do things. Now, there is a series of steps between, there's a question, why do we have too big to fail? There's one view that the large banks have a funding advantage. They can fund themselves more cheaply than the smaller banks, and therefore, being large, they tend to get larger. And there's a lot of empirical work that's attempted to estimate these premiums in terms of lower cost of financing that the larger banks typically receive. Well, these results vary a lot, but I'll give you some estimates. From the IMF in its April 2014 Global Financial Stability Report, they say that their estimates are that in the United States in 2013, large banks generally had a premium of about 15 basis points. That is, they paid 15 basis points less. In Japan, it was between 25 and 60 basis points. About the same in the UK, and in the euro area, 60 to 90 basis points. Well, those sound like not much, but you have to remember that the cost, a law I learned from Herbert Stein many years ago, which is the difference between 2% and 3% is 50%. And the difference, 60 to 90 basis points on the cost of capital for a bank is a significant difference. Whether it's big enough to generate the differences in sizes that we see is very unclear. There's also been work done on economies of scale in banking. The early work said there are no economies of scale beyond about 100 billion, a balance sheet of about 100 billion. The more recent work, there is an increasing set of body of research that says that in fact there are economies of scale, and some of them, as you read the literature, look to be economies of scope, actually. They do different things, and that the larger banks may be more efficient than the smaller banks, or as some people put it, there are certain activities that you only can do in a very large financial institution. Now, the theory of too big to fail, and the theory is that large banks are a problem from the viewpoint of stability, has to contend with the history of the Canadian and the Australian banking systems. Both these systems have several very large banks, but both systems have been very stable. In the Canadian case, they haven't had a financial crisis for 150 years. And if this paper had been given in 2005, Marty, if you'd retired a few years earlier, we would have added the British banking system to that list, but it's earned its way off that list. The empirical results on what is the connection between the concentration of the banking system and the number of failures, or the extent of failures, says actually that concentrated banking systems are not more unstable. So that's a problem that one has to deal with. I've spoken to a few people who have experience about all this, and I will add one factor that I believe is important. I spoke to a veteran of the international central banking community and said, how do you reconcile these things? And he said, those Canadian banks aren't very adventurous. Well, I take that to be a compliment. I think he thought it was anything but. Well, why is this issue so important in the debate on reforming the financial system? It can't be because big banks never fail. Some do. Financial institutions certainly failed in the Great Recession, including Lehman Brothers and Washington Mutual. Other banks were merged out of existence, often at very low prices, with the FDIC managing the resolution process. Banks in the UK and Europe failed during the Great Recession. It cannot be because equity holders never lose in bank crises. They lose big. It could be because until now, bondholders in large banks rarely have lost, that's rarely with an R in the middle, rarely have lost significantly in crises. Rather, for fear of contagion, they ended up being protected by the government. Almost certainly, TF, too big to fail, is central to debate about financial crises because financial crises are so destructive of the real economy. It is also because the amounts involved when the central bank or the government intervenes in a financial crisis are extremely large, even though the final costs to the government, including the central bank, are typically much smaller, and in some cases, governments and central banks even come out slightly ahead after the crisis is over and the banks have been sold back to the private sector. Another factor may be that the departing heads of some failed banks or banks that needed massive government assistance to survive nonetheless received very large retirement packages. So there's general public anger at the banks, and that public anger is reflected in the way the Congress relates to this issue of too big to fail. Now, there are a lot of measures in the regulatory reform program, which I won't go into because of lack of time, but they're in the paper, which is on the Fed website now. There are a lot of measures designed to make the large banks safer, of which the most important is that there are surcharges for global SIFIs and for domestic SIFIs. There is also for these structurally important financial institutions a work on resolution mechanisms in the living will. Every bank every SIFI is required to produce a living will which will explain how it will be treated if it goes broke, how it plans to handle its bankruptcy. Now, this is probably an unpleasant exercise, but we all write wills, and maybe they can too. These exercises, I think, probably contribute to helping deal with the problem of the largest banks. Well, there is another thing. Why don't we break them up? If you talk to people, they'll tell you all about Standard Oil repeatedly. They'll tell you about the airlines often. They'll tell you about AT&T. Well, so you could say, well, what about simply breaking them up? There's nothing simple in this area. It's not simply breaking them up. This would be a heck of a mess. Do you break up the biggest 10 banks? Do you break up the biggest and start there and keep going? Well, this could be a very, very complicated system, and we don't actually have a whole lot of evidence that there'd be fewer crises if there were more banks, but smaller banks. You can look around. Lehman Brothers was not a very large bank. It was not small, but it was not huge. It wasn't a bank either, but it was not a very large financial institution. The savings and loan crisis of the 1980s and 1990s, where a lot of things called banks went broke. They were not big, but the government intervened in those crises. And there is another phrase floating around which is called too many to fail. Well, too many to fail means institutions with systems with lots of small banks are a problem. Institutions with a few big banks are a problem. Too big to fail. So this is a problem. But the fact is financial panics can be caused by herding and by contagion, as well as by big banks getting into trouble. So my view is that actively breaking up the largest banks would be a very complex task with an uncertain payoff. So what are the bottom lines? And I give you a list. First, on capital and liquidity. By raising capital and liquidity ratios for the large banks and through the active use of stress tests, regulators and supervisors have strengthened bank holding companies and thus reduced the probability of future bank failures. The paper contains some details on the use of the resolution mechanisms set out in the Dodd-Frank Act, which make it possible to resolve a bank, that is to, in essence, treat it as you would treat a bankrupt bank without following the standard bankruptcy laws. And those mechanisms hold out some promise of making it possible to resolve banks in difficulty at no direct cost to the taxpayer, and in any case at a lower cost than was possible hitherto. But work in this area is less advanced than the work on raising capital and liquidity ratios. Agreement was reached very quickly on how to deal with global significant banks, systemically important banks and financial institutions, and how to deal with their bankruptcies. But there's been much less agreement on that, and there are difficulties in reaching that agreement, and there's work to be done there. On macro-prudential, we need more research and more confidence and on learning which measures work and which measures don't. In the same area, it's important to ensure that coordination among different regulators of the financial system is effective and will be effective in the event of a crisis. On too big to fail, there's a lot of progress being made, and I'm sometimes asked, have we put an end to too big to fail? Well, my attitude to that is we will never know, except when we know that we haven't. Because you can go for 40 years, as the United States did, without a big bank failing, and it doesn't mean that it won't happen in the future. And I would say that we should never allow ourselves to be so complacent as to believe that we've put an end to too big to fail. Because if that's what we think, we won't supervise with the right degree of caution. We should recognize that despite some imperfections, and this is something on which I've changed my mind, despite some imperfections, the Dodd-Frank Act is a major achievement. From a distance, it looked like a big mess. Well, as part of my new job, I actually had to read the thing. Well, it's still pretty complicated, but it contains a lot of very useful legislation, much of which will help stabilize the system, some of which is more complicated. Well, having said all that, I'm coming to the end. We need always to be aware that the next crisis, and there will be a crisis, will not be identical to the last one, and that we need to be vigilant both in trying to foresee the future crises and in trying to prevent them, and in not thinking that what we're doing now will deal with all future crises. And since somebody would ask me, well, what do you think is going to be the source of the next crisis? My guess is that we have made least progress on how to deal with the shadow banking system, and that we're going to have to do a lot more work there. So, if, despite all our efforts, a crisis happens, we had better be willing and prepared to deal with it. Thank you very much.